Okay, students, we're back and we will go over the homework problems that we were up to now. So we'll start with mini exercise 9.4. So, computing book value, straight line depreciation. A machine that cost $400,000 has an estimated residual value of $40,000. So that gives us a depreciable cost of $400,000 minus 40, or $360,000, and an estimated useful life of 4 years. The company uses straight line depreciation. Calculate its book value at the end of year 3. So to do this, we need to calculate annual depreciation. So again, $400,000 cost, $40,000 residual value gives you $360,000 of depreciable cost. 4-year life, $360,000 divided by 4 gives you $90,000 a year. So for 3 years, $90,000 a year. It's going to be $270,000 of depreciation. Subtract that from 400,000, and that'll give you the net book value at the end of year 3. So that would be 400,000 minus 270,000, $130,000. Let's go through that right here. So there is the calculation of depreciation, cost minus residual value divided by depreciable life. So 360,000, that's 400,000 minus 40,000. 360,000 times 1/4 or divided by 4 gives you 90,000 per year. 90,000 per year for 3 years give you accumulated depreciation of 270,000. Subtract that from the cost of 400,000. We get net book value at the end of year 3 of $130,000. Okay. Now let's go to mini exercise 9.5. Same machine, cost $400,000, has estimated residual value of $400,000, $360,000 of depreciable cost, estimated useful life of 20,000 machine hours. Company uses uses units of production depreciation, and ran the machine 3,000 hours in year 1, 8,000 hours in year 2, 6,000 hours in year 3. Calculate its book value at the end of year 3. So again, we have depreciable cost of $360,000. We can divide that by 20,000 machine hours of useful life. That would give us $18 an hour of depreciation per machine hour. Multiply that times the number of hours it was used. So 3,000 hours in year 1, 8,000 hours in year 2. 3 plus 8 gives you 11,000. Plus 6,000 would give you 17,000 hours of use, times $18 an hour would give you accumulated depreciation. And then we can subtract to get book value. Let's look at the answer and let them do the math for us. So again, there's the cost, and the cost minus salvage value divided by the machine hours of life gives us $18 per machine hour depreciation. 360,000 divided by 20,000, $18 per hour. And then the use, 3,000 hours in year 1, 8,000 in year 2, 6,000 in year 3. So that would give us $306,000 of accumulated depreciation. So net book value would be $94,000. Okay, so let's move down to mini exercise 9.6. A machine that costs $400,000, has residual value of $40,000, estimated useful life of 4 years. All that sounds pretty familiar. Company uses double declining balance depreciation, calculate its book value at the end of year 3. Okay, so 4-year life, straight line would be 25%. Double that is 50%. So we're going to take 50% of net book value for depreciation expense each year. So year 1, $400,000 net book value times 50% would give you $200,000. Okay, then we have a net book value of $200,000, $400,000 cost minus $200,000 accumulated depreciation. So that gives us $200,000 of depreciable cost times 50%. It's going to give you $100,000 of depreciation expense in year 2. So now we have $300,000 of accumulated depreciation. So 400,000 minus 300,000 gives us 100,000 times 50%, another 50,000. So accumulated depreciations, $350,000, and net book value is $50,000. Now, year 4, how much depreciation would we take here? Well, if you're saying, okay, net book value was $50,000, we take 50% of that, give us $25,000. Whoops, you forgot about residual value. So year 4, that's the last year of the asset's useful life. We have $40,000 for residual value, so we would only take $10,000, $50,000 minus the $40,000 residual value in depreciation in year 4. Not part of the question, but something you need to keep in mind. Okay, we also have exercise 9.6. Give you a little more practice on depreciation. So let's go down to it. All right here we have it. So Solar Innovations Corporation bought a machine at the beginning of the year at a cost of $22,000. The estimated useful life was 5 years and the residual value $2,000. Assume that the estimated productive life of the machine is 10,000 units. Expected annual production was year 1, 2,000 units, year 2, 3,000 units, year 3, 2,000 units, year 4, 2,000 units, year 5, 1,000 units. Compute the depreciation schedule for each of the alternative methods. Round answers to the nearest dollar. So here we're going to do straight line, units of production, and double declining balance. So we have the year, the computation, depreciation expense, cost, accumulated depreciation, and book value. So cost is going to be $22,000. So straight line, I'm going to take $22,000 cost minus $2,000 residual value gives us $20,000 of depreciable cost. I'm going to divide that by 5 years, and that'll give us $4,000 per year. So we'll go over here to the answer. So $4,000 per year every year. And so we see our accumulated depreciation grow by $4,000 every year. Our net book value decrease by $4,000 every year. So there's your amortization schedule there, your depreciation schedule. Okay, units of production. We had depreciable cost again of $20,000. Now estimated life in machine hours of 10,000 machine hours. So Let's see, right there, 10,000 hours. So $20,000 depreciable cost divided by 10,000 hours gives you $2 per hour. So year one, $2 times 2,000 units would be $4,000. Year two, $2 times 3,000 units, $6,000, and so forth. So there we see the computation: 4,000, 6,000, 4,000, 4,000, 2,000. Okay, now double declining balance. Our straight line rate is 20%, 1/5, 20%. So we're going to take 40% or 2/5 times net book value each year. Beginning of the first year, net book value is the cost, 22,000. So we're going to take 40% of that, 8,800. Next year, we're going to take net book value, which is 22,000 minus the 8,800, and multiply that times 40%. That's going to give us depreciation expense of 5,280. So accumulated depreciation now is $14,080. So we're going to take cost minus accumulated depreciation gives us net book value times 2/5 or 40%, $3,168 that year. Then year four, we're going to take cost minus accumulated depreciation times 40%, gives us $1,901. Now we have $19,149 in accumulated depreciation. Our cost was $22,000. Our residual value is $2,000, so depreciable cost is $20,000. We cannot depreciate this below $2,000 residual value. So we can take our $20,000 depreciable cost, subtract accumulated depreciation, and that would give us $851 of remaining depreciation we can take. So we take that in year 5. Okay. So hope that clears everything up for you. And okay, that finishes off that homework problem. Okay, requirement 2. So there were more requirements. Let's go back and look at them. There it is. Which method will result in the highest net income in year 2? Well, the highest net income would come in the year with the lowest depreciation expense for that year. So does this higher net income mean the machine was used more efficiently under this depreciation method? No, it does not. The depreciation has nothing to do with efficiency. Okay, so which one's going to give us the lowest depreciation expense in year 2? Well, the answer is straight line, $4,000. Under units of production, we had 6,000, and under double declining balance, we had 5,280. So the answer is straight line. So method that will result in the highest net income is the one that reports the lowest depreciation expense. This example, straight line depreciation method results in the highest net income in year 2. This higher net income does not mean the equipment was used more efficiently under this method. Okay, so that gets us through those homework problems and gets us to approximately the end of this time for this video. So I will stop now and pick up the chapter with the next video.